Hi everyone. So let's talk about what products you should not trade together in the commodities market, and let's talk about all the correlations we might have and how they change based on the season and based on the winter or the summer or any kind of geopolitical situations, and also talk about specifically the volatility correlations, which is also a pretty important thing in my opinion, which is definitely overlooked. So this is somewhat of a, I guess, boring video, but really important. It can really make a huge difference for your trading. Now, this is my strategy. So this is exactly what I do. I'll go over it very quickly, and if you watch any of my other videos, you can just kind of skip it with the markings below for the player on YouTube. So it's basically, I usually trade 90% of the time, or probably 95, just a short strangle, but I can definitely sell some calls, some sell puts, but it's always going to be short. I'm always going to be selling options and getting the premium. So I usually look for 45 days or less, but lately I've opened a position with 105 days because this is where the best deal was at that moment. So I'm always looking for the best opportunity where the risk is worth the reward. And I will definitely try and stay at 45 days or below, but this is just kind of a rule of thumb. But obviously, it depends on the situation, and in some situations, more days to expiration will make way more sense. Now, these are the products that I trade. So these are basically all the futures options that are liquid enough, I guess, to trade with bigger amounts. So these are the ones that I stick to, and these are the ones that I have the most experience with. And short strikes are always delta 20 for short strangles, and about delta 35 for calls and puts. Now, profit target is always at 50% of credit. Loss target is 50% of credit as well. So I risk one to make one. My win rate is about 93%, but I'm very, very picky, because I used CVOL for good entry, and this is just the commodity volatility index, and I'll link the video for it below. It's a really important, really useful tool. It's basically the Bible for option sellers in the commodities market. Without this, you cannot make any informed decisions. Now, my exit rules is I exit when either of one of my targets are hit, profit target or loss target, and I forgot to mention my loss target is dynamic. Basically, when the profit is about 25% of credit, I move my stop loss to a loss of 25% of credit. Then when I'm about 40% of credit, I move my stop loss to 10% of profit of credit. So just kind of lowering my risk as the position is getting better and better and more profitable. I can exit the position in 21 days to expiration. Now, usually we never get to that point, but if we do, I definitely don't want to stay in a position. But again, I might stay another day or two. It really depends. But these are kind of things to kind of keep in mind when you open a position, and when you want to exit a position, or when you get, if the position is barely profitable 21 days, then, there's no point keeping the position open. You can just close the position. But if you're like almost at full profit target, maybe it makes sense to wait maybe another day or two. So it depends, but overall, 21 days to expiration is a good number to be out of a position by. Now, I might adjust the position if needed. Basically, never do it. I might do it, but if it makes sense. But usually, I never ever do it, and I can exit early if it's at the end of the year or something unexpected has happened that can affect my position. Like some kind of geopolitical tensions or some kind of policy changes in different countries that can affect the commodities. And again, very important, I always just look for the best possible deal or a good opportunity where the risk is worth the reward. So this is what it's all about. Now let's talk about the correlations and what are futures correlations. So basically, it's two or more different commodities that have a similar price movement normally and during news and reports events. So basically, it's really simple. So let's say you have a position open on corn and on wheat. So this is basically two products that have a lot of correlation. Now, not always, the correlations always change. They can increase, they can decrease, they can stay the same for a while. But as a rule of thumb, and I'll go over exactly what products to trade together or not to trade, or at least what I'm doing and that has been working for me for the past 9 years. But basically you want to avoid just being over leveraged by having two positions that are affected by the same underlying supply and demand chain or supply and demand issues. So this is exactly why it's important, right? Because corn and ZW, they're both are likely to do to do the same thing or move in the same direction, and we just don't want to be over leveraged, and we want to have some diversity in our position, right? So it will be much better off to have a corn position and maybe a gold position. If something happened to corn, for example, and or something happened to the corn supply and demand chain, or there's less demand or whatever it might be, gold is likely not to be affected because there's barely or any correlation in between them, right? So one position might be losing and the gold position might be winning, right? So it will overall increase your account stability, which is really, really, really important for your Sharpe ratio. And overall, I guess just you want to be able to keep your account as stable as possible and grow it slowly but surely. And correlations is just a huge thing for me, because you can make a lot of money if you completely avoid correlations, but you can also lose a lot of it very quickly. Now, like I said, correlations, they change over time and it's based on seasonality, and I'll talk about it again in just a few slides. And again, correlations are the key for account stability and help massively to decrease risk and leverage. So let's talk about all the commodity correlations, and this is basically the way I see, the way I trade them. So we have gold and silver; they're both pretty highly correlated. So I will never ever trade gold and silver together. I will trade one or the other, probably gold, because this is the one that I have most experience with. Now we have corn and wheat, we just talked about it. So I would only ever have a position on one or the other. We'll never have positions on both of them. We have soybean meal, and soybean oil. So I will only again ever have a position on only one of them. Now sometimes the correlation in between these is not big, and you can get away of opening a position on soybean and then soybean oil. But again, as a rule of thumb, I will probably never ever do it, because you don't know when correlations will become higher, and if you're mid position, it can really hurt you, and this is just not a smart kind of like gamble or smart risk to take. Same with corn and wheat. Sometimes they go in a completely different directions, but it doesn't matter at the end of the day, because you don't know what's going to happen. But historically they have a pretty good correlation. Now let's talk about corn, wheat, soybean meal, and soybean oil. They have a high correlation around April to July, and so during these months I probably won't trade any of them regardless. But this is my explanation on why they have a pretty good correlation during April to July every year, because this is when the crop harvesting and planting takes place. So this is where essentially things become really volatile. And next slide will be exactly about that topic, about volatility correlations. But this is also tied to seasonality, which is another video I made, which is really important because seasonality is a big thing for grains. And we want to avoid just low probability trades. So from April to July, I don't trade any of them. But especially if you have some kind of insight or whatever it might be, trading two or more products from the grains during April to July might not be a good idea, because you'll be over leveraging and you might just get yourself into a bad situation. Now we have natural gas and crude oil. Generally they have a little correlation, because this is the energy sector. So as far as you can see, it's based on the sector. So we have metals, we have the grains, we have more grains, the soy grains. Then we have, this is based a little bit on seasonality, about April to July. Then we have energy. And energy products, they have little to no correlation, but during extreme cold weather, they can definitely have much higher correlation, which is just kind of my point. Is some certain events in the world, it can be really cold weather or something really crazy. It can really affect the correlation across multiple products. And usually when something bad happens in the world, correlations tend to rise. Now we have So just to be clear, I will definitely trade natural gas and crude oil together at the same time because they have little correlation. Unless it's winter time, and in winter time I don't trade natural gas regardless, and usually there are no good opportunities on crude oil either. So winter time is definitely is not the best time, I guess, for the energy sector because it's more volatile and correlations can really rise up. So now we have LE and HE. So these are the meats, lean hogs, live cattle and lean hogs, and generally they have high correlation to each other. But again, sometimes they just go in completely opposite directions, and this is not something that can signal me, hey, I can open a position on that and on that, because again, this is all livestock, right? They like a lot of times they are being like grown together, right? So if something happens, if it's really cold, both LE and HE will be affected, even though their prices might be going in a different way. And when something happens, correlation will rise, especially for the meats as well. And again, it's usually weather is a big thing for meats as well. Same with energy sectors and with the grains. Now we have the currency futures, and they have really high correlations to one another because they're all measured against the US dollar. But there's way more factors at play, and these are not really commodities, I guess. Commodities are more, I guess, like actual food and stuff, and energy. But this is also something that I can definitely trade, but I will never ever have a position on, let's say, the US or the Canadian dollar and the euro at the same time. It's only going to be one or the other, regardless of the time of the year or the season. I will probably never ever open two positions at once from the currency futures. And as I mentioned, during major events, correlations rise extremely quickly. Prices might or might not go up or down. I'm not sure, but volatility will definitely increase across all products. So let me give you an example. So when the conflict between Russia and Ukraine began, corn and wheat they had a significant increase in price and in volatility, and basically they were moving the exact same way, right? Because Russia and Ukraine, they export over 25% of I think the wheat in the world, and over 30% of corn to the world, right? So there were major concerns of the supply chain being disrupted. Therefore, the price went up, and of course, when commodities crash upwards, volatility goes up quickly. So these are the kind of major events you can kind of be thinking about for specifically, I guess, for corn and wheat. And this is not something that I just basically I always run in my head and try to figure out what's going to happen if one country does this to another country. When that happens, you just react to what the market happens or to what the market does based on what happens, based on the news, and you just gonna pick your spots and do the best you can do, right? So there's no way to predict what's going to happen, and it's not our job as traders to do it. But using correlations, you can dramatically decrease your risk. If, for example, you have a position on, in your portfolio on gold, where at the same time you might have one on wheat, on soybean, on natural gas, and maybe one of the meats, right? This is a really, really well diversified portfolio, and where you have little risk, basically. So if one position goes really bad, you have the other ones that are profiting, right? And this is really, really key. It helped me out so much, and definitely changed my perspective on trading, because a lot of people are really, really heavily dependent on only gold, or maybe they only trade like the SPX or DS, and they're extremely leveraged without even understanding that all they have in the position is the S&P, or things that are correlated to the S&P, right? So something happens to the S&P, or something global happens, the S&P reacts, and all of their other positions react at the same time, and this is just not a good thing to go through. So last but not least, let's talk about volatility correlations, which is really important. Now it spills over a little bit to like reporting and reports on different commodities, and obviously on the economics of the US and other countries. but I think it also has a place in this video. So let's talk about it and see what how this can also help us potentially make some good decisions. So volatility correlations is basically when a known or surprising event causes volatility to increase across different products at the same time. So if we have the CPI, the GDP, or the Feds, they're lowering rates, so on and so forth, or something major, something that is not scheduled, like the CPI or the GDP, something like the Japanese stock market crash, right? These events will cause increase in volatility for gold, silver, all the currency futures, and sometimes even crude oil, because crude oil sometimes acts more of a currency other than a commodity. It really depends. Gold definitely acts completely as a currency and not as a commodity. Silver is so and so because it is pretty useful in many applications. Gold is just more of a store value at I guess at this point when I'm making this video, and these are the things that can affect those few products. Right now we have, like I talk about, the seasonality for the seasonality volatility for corn, wheat, soybean meal, and soybean oil. And volatility will increase during the harvesting season, which is usually from April to July. And it's different. It's every year is different. Sometimes it affects it more. Sometimes the volatility goes up not as much. But you can definitely bank on it that volatility will increase during these months, and it will increase across all of them. So again, I don't know where the price will go. The price of each and one can go in different ways, and it can go up, down, it can stay the same, but volatility will uniformly increase across all of them most of the time during these months because of the harvesting season. So this is what I mean when I talk about volatility correlations, and not just price correlations for the commodities themselves. And I know it's a bit confusing, but it's really essential. And once you get it, it's gonna be much easier to kind of navigate around. Now LE and HE, obviously they're correlated by price, but they're also correlated by volatility. And things like Thanksgiving, Christmas, where people when there's way more demand, I guess, for livestock, for meat, people just buy more meat, I guess, at the store for the meals and so on and so forth. So the demand increases. Usually price increases as well, not always, but volatility definitely increases every single time up until after Thanksgiving and then after Christmas. So this is about the meats. Now, major events that affect the US dollar will cause volatility increase across all products. It's really rare. So a good example will be, if the Fed is gonna just print an unimaginable amount of money and inflation will be crazy, because basically everything is measured against the US dollar, it will get affected one way or another. Or if it's not affected by price too much, it will get affected by volatility. But again, this is very rare. Rarely happens. It happened in COVID to an extent. wasn't too bad at all for me specifically, I guess. I was well diversified, and some positions took hit, but some other positions just didn't really flinch. But volatility did go up, so it kind of hurt the position, even though the price of the underlying did not move. So this is it. Let me know if you obviously have any questions. This is a boring topic, I guess, in a way, but really important. Will definitely help you make some good decisions and put you on your path to profitability much sooner than if you would have avoided the correlations and the volatility correlations, and what products to trade and not to trade together.